what are the 5 factors which make RE firms attractive to PE firm? And what do you think are some of the mistakes that the RE firms make?
Well, let me take the last question first. It's not just the RE firms who make mistakes, it's fund managers like us who make mistakes as well. As you said, we've been doing this since 2005. And the first fund was actually registered under the regulations at that time, under the Venture Capital Fund regulation. It was a VCF, Venture Capital Fund. And I didn't know anything about real estate at that time, so when I started investing, it turned out to be adventure capital rather than venture capital. Learning from that adventure, I can share some of the learnings. I think the first I would say is that most proposals that we get are reasonably ambitious in terms of timelines. And oftentimes the difference of opinion between an investor and the proposer is the timelines on which that project will get executed or sold, as the case may be. Wherever we have lost money or we have not made adequate return, it's on account of 2 factors. One, either it was the timeline that we bought into was very ambitious, or there were circumstances which were beyond the control of the developer. For example, during the period when Mr. Subodh Kumar had come in Mumbai, when approvals got stalled for a very long period of time, I don't think it was the fault of the developer. But the reality is that there was capital that was already invested by investors like us, and along with the developer, we were also suffering. I'm sure certain other developers may think that we had invested as a fixed return instrument and therefore they were obligated to pay that. And we were obligated to take whatever suitable actions that were required to recover that fixed return. But that is the reality of life. I think from an asset class point of view, it continues to be pretty interesting. The good news for people in the room here is that apart from the fact that we are all meeting personally for the first time, or we've started meeting personally again, there is a lot of money that is coming in from very large investors, and we are back to, in terms of at least capital availability, somewhere in the region of 2007, 2008. We are inching up there. There is far greater amount of capital availability. The difference this time around is that the capital that is coming in either in partnership with players who have established track record, who have systems, processes, and investors are really making sure that they partner with people, both either as fund managers, whether it is Vipul or myself, who've been there for a long period of time, or with developer partners who have been there for a long period of time. So as long as you've got a decent track record of development, delivery, you should be able to get capital. So the attractiveness of the asset class is back. The only difference I would say is that between 2007, 8 and now, helicopter money is not yet here. People come in, throw money and then go away. There are some projects where money of that helicopter is still stuck. We are all aware of that.
Navin, as a representative of the RE firms here, what have you seen are typically the concerns or the questions that private equity investors have with respect to RE investments?
So in our case, we've had 3 private investors investing at different stages of company. And in all 3, I think, as Srini mentioned, they're looking at realistic numbers, whether it's time, whether it is time to completion, approvals. They're not looking at cuteness of approvals, ye ho jayega, kar lenge, so that things don't work. Plus, your track record, which I think is even for customers, your track record is important, and how you deal during adversity. So these things do matter a lot. And apart from all this, in the entire journey of the investment, you will have your ups and downs. And how transparent are you with them? How are you actually sharing your problems? Are you keeping them aware of what's happening? I think the more you are involved with your private equity, the more comfort they get, the more they are in with you in the project. They are not shy from knowing what the problem is. If you start hiding, then you start doing things which are they are not aware, and then they feel that you're not running the project in transparency. So once they are in the project, I think having regular meetings, keeping them fully updated, because they are your partners, always helps. And which is why we've been able to get the same set of investors coming back and investing the second and the third time. Before investing, as I said, they look at ensuring that your expectations is realistic. And why are you not taking a debt versus why are you taking a private equity? There has to be a logical reason that you're doing, because you need more patient capital. If those reasons are there and your track record is there, then I don't think so you face any problem, and the private equity is even comfortable. Thanks.
Mukesh, the next question is to you. People continue to be wary of investing in under construction residential projects. Now with RERA in the picture, do you think this fear of projects getting stalled is getting mitigated? And where do you think there are still some issues?
Thanks, Lata. So first of all, RERA is a very welcome move. It provides transparency, it offers accountability. We are all very happy about consumer right protection that it offers. On top of it, the whole idea about escrow mechanism is a great step. It tries and ensure cash flow mismatch at any point of time. You have enough funding provided for. The challenge that I see as an investor when I'm looking at real estate in India, we have a significant reliance on receivables, customer receivables. And in case the project were to go south at any point of time, either on sales or collections, we see it hanging dry. So one of the key issues that I look at when I'm evaluating a project or when I'm working with a partner is to figure out how much or what is the kind of capital stack that we're looking at. Has it been provided for enough equity or it's highly levered? And if it is highly levered, the solution is to provide more equity towards it rather than levering it up more. The second issue that I have seen RERA coming in, post-RERA coming into picture, and there are mitigants around it. Unlike what used to happen in the past, Srini and Vipul would have seen, we had an ability to replace the developer in case there's a non-performance. With this whole idea about two-third customers' approvals, it becomes challenging. So people become a lot more cautious about what is the kind of partner that they're looking at and whether that partner is aligned with what your interests are. These are the two aspects that I think we need to worry about when we are looking at residential.
Vipul, you're one person, in fact, who have consistently invested in residential real estate in India. Could you share some of the learnings that we've had and some of the successful PE investments that have been made?
See, I don't know about the success part of it, but one thing I know is that in last 17 years I have been in the industry, there's an element of grass is green on the other side. So fund feels that the developer is making money, and I know probably 90% of, or if not 100, they'll say fund, I would have been better off 18 years back being a fund because the banks have made more money than the average developer who has taken a lot of debt. And I think in certain ways, both have their reasons. The key is, Srini was talking about it, key is going forward. What has happened, but going forward, I have a little bit of a disagreement. I think this is a time where, as an entrepreneur, if I'm a developer, I should dream big, but I should not use debt to fuel that dream, which a lot of people have done in the last 10, 12 years. You should do public equity, private equity, pre-sales, whatever you need to do, notwithstanding the RERA and all those things, factors, but don't use debt to buy FSI and all those things, because of, there can be any other factor, like he mentioned about some regulatory factor, there can be some geopolitical factors, so on and so forth, because debt automatically compounds. That's one. Number two, I think, and especially because I'm assuming bulk of the people here are more Bombay, it's a Bombay conference. It's a national conference, but in Bombay. But there is a tendency, and rightly so, to stick to your area. But everybody, I would seriously recommend, we were talking in the pre-event thing also, the core area is now getting expanded beyond, say, in Bombay, it is no longer Bombay. Please, I would seriously request everyone to explore that the level of infrastructure development, especially roads, the pace at which it is happening, is opening up cheaper land parcels in the outskirts of your core area. Look at non-core, say 100-kilometer radius of whatever is your what your focus area is, and there is some serious money to be made in those areas. I know a lot of people say, I want to stick to Bombay, maybe Western lines, Eastern lines, so on and so forth, within Western lines, South Bombay, North Bombay, which is true, but if you see anybody who has made long-term money, it is by holding land on equity and more than 5 to 7 years. That's how the top 10 developers have made their big bucks. So that's the second thing. And third is, don't trust your fund manager like us only. Have good CFOs. I would seriously recommend the entire community to give more credence to your finance people. When I say don't trust means, if I am giving a plan which is outrageous or super aggressive, and the other person is agreeing, then fault lies with me, but to some extent, Srini mentioned, also lies with the person who is funding me. So I seriously believe that a lot of promoters don't give the right kind of weightage to their finance people. And they have not invested in the right kind of finance and risk people. Somebody who can hold back and question what the promoter's assumptions are on a piece of thing.
Very good insight, Vipul. Coming to you, Srini, in what circumstances should an RE firm choose PE, and when should they decide to go for an IPO?
If you are a residential developer, please don't go and do an IPO. It's a project level kind of company, and you are expected to provide quarter upon quarter growth, numbers, etc. And it's a cyclical business, and you will not be able to do this meet the quarter upon quarter expectation, except after 6 o'clock in the evening in the bar. So, residential, I would say stay out of being an IPO. There is going to be enough capital without listing yourself, unless you have such large scale that if you are a residential player, I would recommend not to list. And new accounting in terms of project completion, so it just complicates life further. During certain periods of time, it might be useful to do a QIP, etc., but in reality, the headache of managing a listed company is very large. If you are, asset owner or, then it's a different story. And I would say if you're an asset owner, you would rather list it like a REIT. So public equity listed company, probably not such a great idea. Please do take equity as Vipul is mentioning at the project level. You can do multiple equities. You can do multiple projects with multiple financiers. All of that becomes a big challenge when you're a listed residential developer. There are lots of issues. If you're a listed residential developer, and then if you have a subsidiary which is also a fund management company, I am as a shareholder in the listed company, and I'm going to ask the question, why is a particular project there in the separate fund management company, and why is it not in the main company? What are the economics that you are giving away by doing this? So there are lots of issues that will come about. Please also remember, we are now in an era where public shareholders are going to be more active. They are going to be more aggressive. The rights of public shareholders are far greater today than what it was even 3 years ago. And you are going to see the development of activist funds in this country, which means people will take a 4 or 5% equity position in your company and come and create ruckus in your shareholder meeting. And they are going to go to the regulator, and they are going to constrain your ability to act freely like you would as you are an individual entrepreneur. And this is a business that you've got to be smart, you've got to be on the feet. You can't be, taking consultation with 20,000 shareholders and taking a decision. It doesn't work that way. So, strong recommendation, those who are harboring going public, please don't do it.
So Chirag, this is a good segue to ask you the question. Essentially, do you have a contrarian view here?
So I guess I'm going to bring the other side of the perspective on this, which is to say that
you heard the panelists talk about not levering up more and using equity. Of course, you have the private side of the equity that you can use. To my mind, and this is a question really for everyone to reflect on, you today have 8 large listed players in the MMR region that primarily operate in the MMR and other regions. I'm going to list them out. Everyone knows it. Oberoi, Godrej, Prestige now has come in here. Suntec is there. Raheja's through their REIT. Lodha, Embassy through Indiabulls Real Estate. The question is, we've all seen consolidation play out over the last 5 or 6 years, post GST, demon, etc., etc. I mean, I was reading some stats that basically spoke about the market consolidating significantly, and the branded developers, however they were defined, now equating to 35% of the sales that were happening versus 17% 4 years or 5 years back. If the consolidation is to be believed and that's to continue, how do people in this room expect to compete with people who have almost instant access to capital 5 years out? I mean, some of these listed names could raise upwards of 2,000 to 5,000 crores in 10 days. How do you expect to compete with some of these guys with that kind of access to capital if you don't come to the public markets? Srini, of course, highlighted, what I would believe is, and rightly so, that the most glorious picture around how public markets could work for you all. To my mind, if you're of the size, the market and the investors now understand that there is a terminal value to a business, that this is a project by project business, that there is, land banking used to be a theme earlier. It no longer is. It is now up to your execution, and it is the brand that you create. So I think the investors have started seeing this, the public market investors see this space very differently now. To my mind, if you're of the size, this is the best access you can get to capital. So exactly the flip of what Srini was saying, I would say, come and meet me on the sidelines and do an IPO immediately.
Chirag, one more. Okay, sorry, Vipul, you have
I have something in support of Chirag. Gone are the days, and maybe supporting him also, but gone are the days when you tap the capital market and say, I tap the capital market, I get my money and I scoot. What Srini is saying is right. Clearly, that is not the play. But at the same point of time, if I need equity and there are no funds who are giving equity, then how do I raise equity? So I have to raise equity where it comes from. One place is capital markets. If I am willing to do 3-4 things, A, not having a TV ticker on my room as a promoter, so I am not tracking my price of my share on a daily basis. If I am having faith and doing things that I'm not bothered about what is my market cap versus the person who are the other 8 and other 10, if that is not the obsession I have as a promoter and I want to do my business in the right manner, you have to raise equity. Now, there is only that much private equity that is available, which is true blue private equity. Very few people do it. And whoever is doing it is having significantly higher constraints on me as a promoter on that project than, say, what a public market would. At the same point of time, I think the ability to raise secondary capital after I'm listed is much more. He didn't give the example, but without naming, one of the big boys of Bombay listed, and their overall cost of funding has gone down by 40%. It has completely transformed that company. So why would I not do it? Because the cost of debt by so-called fund managers sitting with 15, 16, 18, 20 years, which reflects our age, but saying that this is what you should do, but they are giving expensive money. Ultimately, money is a big cost for me. I need to reduce my cost. So I need to get equity at any cost from wherever.
Great. Chirag, a question to you as a corollary actually is, what's your take on performance of realty indices and one of the longest bull runs we have seen in the Indian market? There have been corrections in the US market. Indian market is still holding its own. Do you think we are out of the IPO bubble, or do you think the momentum is here to stay for some more time?
So I'll just add to what Vipul was saying and then take your question. The basic thing that I want to put out there is really how, as a developer where capital is your raw material, can you think about ruling out one source of capital and to just say that I won't tap public market? It's like saying handling banks is becoming problematic for me, so I'm just not going to borrow. Right? It's the real equivalent of that, and that just doesn't fly. Equity or capital is your raw material. You've got to take it wherever it comes from. Some days it'll be easy, other days it won't be. Well, so is it with permissions, and so is it with selling apartments. So you have to decide which way you want to do this. To your question, the real estate index has, at last count, has outperformed the Sensex by about 24% in this year. When I look at it for the last 2 years compounding, I think, it has again outdone the Sensex by quite a bit. You've seen both the REIT developers or the REIT listed players as well as the residential, listed developers actually doing well, both on the tailwinds of the fact that increasing sales over the last couple of years, as well as the cost of capital coming down dramatically. I don't think that scenario is likely to change. I think what we are seeing is a lot of the listed developers have used the last 2 years of the tailwinds in the business to fix their balance sheet, to change the orbit at which they operate, and the confidence that some of these investors now have in the listed names bodes really well for them. So I think that bull run for them continues. If you're a public market investor and you wanted to play the upcycle that is fairly visible in the residential real estate space, there are a limited number of names that you can play this through. So those in the listed space will continue to take the benefit of that.
Navin, being the privately owned developer, and you're seeing most of your colleagues looking at listing, Srini's concerns notwithstanding, what do you think? Does this give customers a sense of confidence when it's a listed company? And does it really help with your overall brand value?
So I'm with Srini actually. So we believe in what he's saying. No doubt, I believe that cost of capital, access to capital, quick capital is definitely a benefit that you get. But we are on an upturn of the real estate space, so I'm sure it'll have its own nuances as we move forward. I think a customer, from the lens we see it, if there is project is at a good location, your project is doing well, it's getting completed on time, and your quality is good, it doesn't really matter if you're listed or not listed. It does. We've seen sales irrespective of sales happening across in all our projects without. I don't think so. This really matters to a buyer. Yes, as a brand, it does gives more comfort that a listed entity is far more cleaner. But as a customer perspective, if your project is doing well, if it's good quality, sales do happen. Thanks.
Vipul, question to you. I think given the onset of PropTech and that being the flavor of the day in a way, one question which I had for you was, we've seen PropTech investments by PE being done primarily by sector agnostic PEs, right? You have not had any of the real estate PE players look at PropTech as an investment. So, what are your views about that?
See, I think the secretary also mentioned, but the biggest problem of PropTech industry is that everybody thinks it's good for angel investment and not good for use in my company as a developer. Every developer, we are talking about it, I think a lot of developers would be angel investors in some PropTech company. They say, listen, it's very good. You are a smart kid trying to do something. I'll invest in your company. But when the same person says, this is a solution, can you use it in your building in some way? He said, for that, you talk to my team, which basically means it's not going to happen. And trust me, I think technology is overrated. Personally, I have trouble managing my iPhone, so my technology coefficient is very low. But a big part of technology, like we talked about, technology in PropTech means faster construction. I remember there was some video which was viral about 3D printed homes. I must have got at least 100 messages, 10 of them internally saying, you talk PropTech, see what is happening here. Why can't we make homes in 3 days and 10 days? China has done something in 9 days, blah, blah, blah. And that's good for conferences, good for discussion, good for questions, but very bad for when you go back to your offices. And I think even in simple RCC structure, if funding is done in advance properly month on month, you can make a G+14 structure in maybe 12 months to 14 months. So where does technology go? So finance is also a big part of that pace of construction, number one. Number two, I would urge the industry, it's an industry forum, I would urge you guys to not go from 4 years to 3 days. Go from 4 years to maybe 18 months. And don't talk about just doing RCC to 3D printing. Maybe it means you digitize some part of it. Maybe there is lender's engineer, there are drones, there are project management, there's a whole scope of things. I still feel that the emphasis of it is still in industry forums, and the practical usage of this so-called technology is very less. And it has to come top down. In an industry like ours, it has to be that the promoter who is a willing investor because of his circle of friends in a new age digital company, thinking that this company will become 100x, one investment out of 100 will take care of my money. Can they be a user of that in some way or the other? And I would urge everybody to see that you actually start using it in some way or the other, whatever part of your process. If you have hundreds of processes, maybe take 3 out of them. Maybe take something, maybe set up a group. I would seriously urge Naretco that if you can take a lead in this, because this is changing in a way that we all cannot comprehend. What has happened in 2 years and what will happen next 2 years, nobody can guess. But one thing definitely will happen, that construction technology is different, but process-related technological inputs is here to stay. It is changing everybody's life, all of us. It will change construction process also. So you should set up a group. I would recommend set up a group, maybe get a group of 20, 30, 50 developers who are ready to adopt if 5 things are being adopted by the big boys. I would urge Sandeep to maybe take the lead or Rajan to take a lead. Because if you guys take the lead, then anybody else will say, the first question I ask is, who is your client? They say, okay, who are, he says, I have got these 5 big boys as clients. Then he says, oh, fine, I'll use it.
Chirag, corollary to that question again is how hot PropTech is in the Indian context as far as the investor sentiments are concerned.
So, I mean, the Indian context is still a very small speck on the entire pie that is, of what is going on globally. I mean, when you look at the numbers, the global investments in PropTech have been upwards of about $35 billion. India, you've probably seen like $500 million at tops, right? So it's still a very small, small portion of it. But I agree with Vipul. I think, a lot of times when things get the fancy, they run ahead of themselves. I think for investors or anyone looking to invest in this, you have to start looking at the fundamentals there and whether there is, real value to what you're paying here. Of course, there is the whole story that can be built around it. But really, is this really adding value to the business that you're doing? And does it really disrupt anything, or is it just a lot more of storytelling, really?
Mukesh, question to you. Just wanted to check whether the pandemic has, in any way, affected the way you look at IRRs on projects.
No, I think, that's $1 million question. Let me start with that, right? I mean, there's no right answer to that question. But the better way to think about this is, I think we are all smarter today. We understand the risk better than what we used to understand, let's say, 2 years back. and thus the IRR is more adjusted for the kind of risk that we undertake. The return is more aligned with the kind of risk that we undertake. I would not say that it has become higher or it has become lower. That would be very wrong. It's all about identifying the element of risk and pegging the return around that. What definitely has changed, though, on account of pandemic, is the kind of asset that everyone wants to buy. And I think Srini was touching upon it when he tried to talk about what's accessible to public, what's not accessible to public, where one should go ahead and raise. Just a follow-on or corollary to that, what has happened is that people have now started contemplating diversifying portfolio allocation. I mean, we are no longer only looking at two traditional asset classes. We are talking about prop tech, we are talking about other investment. On top of it, we are talking about digital infrastructure. We are seeing warehousing as an asset class that has emerged quite strong over the course of last 2 years. We are seeing flex. So I would say more than thinking about evolution on the IRR, evolution has happened on portfolio allocation and identifying a diversified portfolio. That's more what we are evaluating.
Srini, your thoughts?
Yeah, I just want to add a couple of things. You know, when we talk about IRRs and the partnership between investors and developers, I just want to share with the audience here what happened in several of our portfolio investments that we had done when the country was shut down and we were going through COVID. What did we do? We obviously knew that the project cannot progress further in certain parts of the country. Labor was not there. You could not go out, etc. But we really did a big deep dive in terms of how each of our developer partners is focusing on sales, collection. We actually went out, we created an Excel sheet for each of our developer partners. How much sales have happened? What unit has been sold? Which unit has been financed by which bank? So that we know that amongst the NBFCs also there are casualties. So if I have 20 customers who have been financed by DHFL, मुझे पता है पैसा नहीं आने वाला है. So you have to do a very deep down analysis, and we shared this analysis with our partners. We said, you know what, this is the problem. When the country opens up, you're not going to get this cash flow. So you have 30% of your customers mortgage finance, 10% of your customers mortgage finance by mortgage financiers who are not going to be able to pay on time, and balance 30% as individual businessmen whose businesses are going to be affected, and they are not likely to pay on time. They may pay with a delay. So you then project what is your cash flow that you are going to suffer, budget for it. We actually put out additional money, but we said don't stop construction. One of the things that we realized was that if you can pour concrete on the site, we will put additional money so that you continue to pour concrete on the site. 3 things happened. When the market opened up, sales came roaring back. So we made up a lot of things because we were able to show progress. So it's important that the partner understands your business in great detail. The second thing that I want to share with people in the room here is that as we did that analysis, we did very detailed analysis in terms of if we had an investment in a particular micro market, what unit size is selling, what is the square footage of that unit size. Because developers would come to us and say, हमको 3 BHK बनाना है. नहीं बनता है बॉस उस लोकेशन में. This is the actual data कि क्या बिकता है क्या नहीं बिकता है, and it is based on actual data. Third, with regard to how we are thinking about in a particular location, when people come and tell us that I'm going to sell X million square feet at Y price and this is going to be my combination of product that we are going to do. We want to cut down the entire time frame of seeing a proposal, underwriting it and converting it. How are we doing it? We are saying, you come and tell me the Google map address of your site. At the click of a button, my system will tell me the 22 projects in a 3-kilometer radius around that Google map site, what product has been sold, what price has it been sold, not just new assets, existing secondary transactions also. So I would know in 1 week's time, without going to your site, what is possible in that particular location. And I will either tell you that, look, you don't know what you're talking, or I know better, because I have the data and I have the analysis. And I want all of you to do the same thing. It is possible to do it. If we as fund managers who are not developers can sit and do it, as you make your business plan, use technology to do all of this. It is easy, it is possible to do it. So when there is a downtime, invest in your processes and systems. because that is what is going to take you out of your trouble whenever the market turns.
Very sage advice, Srini. And I think, we can keep discussing this topic, especially with this panel here, and more questions that we can definitely ask and get answered. But thank you all for agreeing to be part of this panel and for spending the time with us. Thank you so much.
Thank you, Lata ji, for moderating this session so effortlessly, and thank you so much to all the panelists for such an insightful session.